Hi everyone, welcome to another episode of Ship It and Sip It. I'm excited to bring two guests to the show this week, and they're both named Konstantin. The first is my colleague and former office mate, Konstantin Kariapin from Paralect. And our guest joining from Germany is Konstantin Lotter. He works with Trustventure and is now one of the advisors on our accelerator program, helping our accelerator founders figure out the financial aspects of their startup and maximize their potential for raising funds smartly and quickly. So, Konstantin and Konstantin, welcome to the show. I'm excited to have you here. Let's start off just a little bit with Konstantin Lotter, your experience in the VC industry and in startups. How did you get into the field and what do you love about it?
Yeah, first of all, thank you very much, John and Konstantin, for having me here today. Really excited to talk to you guys. So I got into the startup ecosystem right after high school. I started working in business development at a prop tech venture here in Cologne. And right after that, I did another internship with a leading German accelerator. And my job was there to connect startups with suitable investors. And that's kind of my first touch point with venture capital there. I then started working with Trustventure. Now my job is to advise ventures on raising venture capital and offering CFO as a service, meaning basically just offering all kind of operational support in all finance-related topics.
Very cool, very cool. And Konstantin Kariapin, did you meet Konstantin somewhere? Can you tell us a little bit about how we made this connection?
Yes, this year we at Paralect we decided that we should visit some conferences, IT conferences. So I was traveling in Europe. I was visiting my cousin in Belgium and saw this conference in Berlin. It was actually a Berlin conference. So I decided why shouldn't I go there and maybe meet some interesting people, founders, investors, different type of experts in different fields. And I was lucky to meet Konstantin there. And I was not even expecting that we would end up here having this conversation today. And I'm very, very excited and pleased that you, Konstantin, decided to join us and talk to us, because I believe you have a lot of experience that you are open to share with founders, with us, partners for a lot of founders. And thanks for joining.
Of course.
So I did a little bit of digging on Trustventure, and on the site it says, the goals of our cooperation with our clients are financial transparency, long-term increase of company values, and the creation of trust by reducing information uncertainties. That sounds ambitious and like a great mission. Konstantin, can you tell us a little bit about Trustventure, what sort of your day-to-day is there?
Yeah, no, happy to. So my role at Trustventure is that I'm a consultant and I work with various startups ranging from pre-seed ventures to Series B plus ventures. And we work with them basically offering CFO as a service. However, we do have a pretty strong focus on fundraising activities, some M&A transactions, as well as investor relationship management. But besides that, our aim is to really be a long-term partner for our ventures and just basically being the go-to person for our clients regarding all finance-related topics.
Okay. So you mentioned that you range from pre-seed to Series A, B startups. Is that mostly focused on the German market, or are you guys EU-wide, or do you expand to global startups?
Yeah, so like you said, we usually start working with ventures once they are aiming to raise their first VC money. But like I said, we see ourselves as a long-term partner all the way to the exit. So our usually mandate ranges from, okay, we are going to raise your first pre-seed round from smaller VCs, all the way up until raising finance for a Series B venture. Since we're based in Germany, most of our clients kind of naturally come from Germany, mainly Berlin and Cologne. However, we also do have some international clients.
All right. Konstantin, you have a question about the differences between Germany and EU and broader market.
Yeah, I actually wanted to ask, since you already mentioned that you work not only with European startups and investors, maybe you can tell this difference, how they differ, these markets, like US market, European market, and maybe some specific in German market.
No, that's a great question. I mean, the US market is just way bigger just because the US market is not as fragmented as maybe the European market. When you look at European markets, you have, Germany, France, Spain, Italy, whatever, all with different tax systems, with different cultures. So you basically need a different go-to-market strategy for all types of different countries. Whether when you look at the US, you basically have a market size even sometimes bigger than whole Europe. However, you do not have these cultural and legal differences so that you can basically just scale and roll out a lot faster. And even for investors, the US market is just so much more attractive because you're able to just catch so much more of one market with basically one go-to-market strategy, just way quicker than trying to scale in Europe.
And do you manage to see any kind of examples when, for example, some US-based investors are investing into European products, so startups, and vice versa?
Of course. I mean, you see a lot of US-based investors now kind of digging deep into the European ecosystem. Some major VCs opening up offices here in Europe, whether that be in Berlin, London, Lisbon right now, also coming in hot. But the same goes for the US. All European VCs also look for investments in the US. However, that also differs from industry to industry. A great example is basically the fintech market, right? Rolling out a fintech in the US is just so much more simple just because of the legal structures there than just rolling out a fintech in Germany or in the Europe in general.
Thanks.
All right, maybe we can dig into one specific side of this difference since it is your area of expertise. I wonder if you can elaborate on, we're going to talk about financial planning. So maybe there are some key differences that European startup founders need to take into account if they have the plan to go into the US market, or vice versa, if there are startups from the US that want to launch into the EU. Does that affect sort of their data rooms, their financial planning, any of the stuff that you specifically work with?
Not really. I mean, the fundraising process for a US-based venture is basically the same for a European venture. Regarding financial modeling, there's also not a lot of differences there. The only difference is basically in your market research, kind of the market data that you then use as assumptions in your financial model differs. But besides that, there are no major differences. So you can build the same financial model for a US-based company than you can base for a Germany company. There are no differences there.
Okay. Well, let's dive into current market conditions a little bit, because that was one of the reasons we wanted to have more experts like yourself on the show to talk about the turmoil in the fundraising market, the venture winter, as some people call it. Do you think that VCs and investors are still eager to invest, or is it affecting certain stages differently? What's your take?
I mean, I would say that VCs are still eager to invest, of course. I mean, that's their job, basically. And what you're seeing right now is that even though the market conditions are in kind of slowing down right now, a lot of major VC funds, a lot of major investors have just recently raised new funds. And that's all capital which has to be deployed within the next 3 to 5 years. So, there just has been a new peak regarding the dry powder meaning the capital which has been collected by investors, however, not yet deployed, just recently, hit an all-time high. And due to the fact that, VC is such a long-term game, these, I want to say, venture winter, how they like to call it, is just part of the ride. And also these kind of winters usually breed some of the best companies. You can see that the kind of number of total incorporations definitely decreases. However, the quality of these companies usually improves just because the burdens of founding and building a company during these times is a lot harder. But since, like I said, VC is just such a long-term game, these investors, they do not look for, buying low and selling high. They rather, always look for a certain type of company with a certain type of founding team, and are willing to pay the respective market price, regardless of kind of the whole economic situation.
All right. Let's dive in a little bit into the causes of this fluctuation or this downturn. What do you think are some of the main ones? And take it from there.
No, I mean, great question. I mean, I think it's really important to understand that, the last couple of years, we've just been in a unbelievable long kind of upwards spiral in the venture market, which was mainly driven through cheap capital. No, I wouldn't go as far as calling it a venture crisis or a venture winter. However, more so of a kind of market correction back towards normality. The causes for this correction are basically like a interaction of multiple macroeconomic factors, such as interest rates rising, different crises all over the world, and just this overall uncertainty about the near future. However, I wouldn't go into panic mode. Like I said, a lot of major VCs just recently raised in new funds, which has to be invested in the next couple of years just because of the business model of a venture capital fund.
All right, so let's dive into some takeaways for startups and founders. What can they do to come out of this ahead? As you mentioned, a lot of great companies have been founded in downturns. The last one was examples like Airbnb, and many other companies grew through the last crisis. What do you think founders should be doing in terms of just winning some of that venture capital that's floating around and being able to grow their businesses despite the market downturn?
I mean, there are a lot of things to take into consideration here. I mean, the first thing that is, I think, the most important one for founders to understand is that fundraising, just got a lot harder and will take more time. In recent years, like I said, we've just been in this huge upward spiral. And investors were kind of more scared of missing a good investment rather than making a bad investment, if that makes sense. We can see that this mantra now kind of switches into a more cautious investment approach. So investors will take more time doing their due diligence and will just be, a lot of more cautious during their investments. Founders definitely should prepare for that. And this is a mindset which won't change within the next couple of months. We suggest our clients, our ventures, to plan definitely more conservative and less capital intensive. Try to maximize your runway while minimizing your burn rate, while still aiming to hit your milestones that you've set for the upcoming year or as well as your next funding round. And that's what we also see from VCs. VCs talking to their portfolio companies, asking for kind of adaptation of the business plan towards a more maximization of the runway, rather than that mantra growth at all costs, which has been definitely dominating the venture market for quite some years. That's kind of the first takeaway that I would give from this. Another thing is that you would definitely need to talk to your current investors and also get in contact with future investors. So really invest into these relationship with the investors. Talk to them even when you're currently not actively looking for capital, but just kind of let them know that you're here. Have update calls 1 or 2 months, and just kind of let them know that you might be looking for investments 6-12 months down the road, and so that they just get kind of a feeling for the development of your company.
And in respect of in these circumstances, changing circumstances that we all face right now, do you see any kind of maybe industries or domains that grab more attention from VCs right now?
I mean, it's still kind of early to talk about which industries are heavier hit than others. I would definitely say that kind of the whole ecosystem around Web3 crypto has been hit hard, but just because this market is currently going through a downturn itself. However, we do not see any specific industries currently suffering more than others.
That's good. That's a
Right.
big chance for anyone.
Yeah, of course, of course.
For sure. This just popped into my head. I've been seeing a little bit of chatter on Twitter and LinkedIn and other places. Some investors and founders are saying that there's sort of predatory term conditions coming back into the game from early stage VCs. Things like liquidity preferences and stuff like that they hadn't seen during the last boom of investing.
Mm-hmm.
Is that something that you've noticed at all in the European market?
To be honest with you, not yet. I mean, these terms that have been outdated for quite a while have been outdated for some pretty big reasons. And so I don't see, this kind of downturn that we're experiencing now for the last couple of months, changing kind of the whole term sheet legal structure, bringing back, all clauses. So with the funding rounds that we've been advising now the last couple of months, we didn't see any changes in the term sheets, making founders, suffer from that, or putting investors into a better position than founders, or even, investors battling themselves for better clauses. We're not at that point right now. I don't think so.
Okay. Something to look out for, I guess, though, for new founders. Okay, let's stick with them for a minute. Let's say we've got a founder who raised a good pre-seed or seed stage just right before the market started to turn down. What advice can you give them in terms of, you've already talked about extending burn rate as far as possible, keeping the team as lean as possible. Are there any other moves they can make so that they're still appealing to their Series A VCs that they're targeting?
I mean, yeah, like you said, the first and still most important thing is that you just have to prepare for, the much longer fundraising process. However, the kind of points I talked about before, getting in contact with VCs early is really, really a big key to your fundraising process, especially if you're looking to raise a Series A and already can show some type of traction in your business model. When you get in touch with investors long before you actively are looking to fundraise, that you've already built a relationship there, this makes then the initial contact when you actually want to raise money extremely easy, and the investor already has this kind of feeling for the development of your company. It is always said that VCs invest in lines, not dots. And this basically means that the kind of investment probability is just significantly higher if you already had, several points of contact with the investor in the past, and he is thus able to understand the development of your company and where you're coming from. This feeling does not exist when you're initially contacting an investor, looking to raise money in 2 to 3 weeks and just sending out a cold mail. Besides that, when you're looking to raise a Series A, it's kind of the first fundraising round where the VC will not solely invest in vision and team, but already in some traction and metrics and kind of more quantitative factors. When you raise a Series A, your product is most likely already live. You have, achieved some kind of product market fit. And so now you're able to kind of roll out and you're ready to scale. This product market fit should definitely be seen in your KPIs and metrics, with a strong growth strategy and the right team in place. So yeah, I would say, just start really early, focus on building relationships first, and be sure that your venture is actually at a place where it's ready to scale its Series A.
All right, that's good advice. Thank you. Let's move on a little bit to your expertise in financial modeling. And I'll play the first-time founder that is not very financially literate. So let's say I have no background in finance, nor accounting, nor am I naturally quantitative in my thinking. How can I start to build my financial model for my startup? Take me from 0 to 1 in this process.
To your first million.
Yeah.
No, John, and great question, of course. So I would start kind of before that, and to start off, it's really important why you are actually building a financial model. And this differs really from stage to stage. So if you're a early stage startup, meaning pre-seed to seed, the main reason or the main motivation for the creation of such a financial model is to showcase that your idea and your business model can actually become profitable at a point in time and will be able to kind of carry on operations without the need of external capital, at a certain time down the road. Your main task there will be to actually portray your business model in a quantitative form. And the beauty of that is that you are able to uncover your most important value levers for your business model. For example, let's say that you're a first-time founder, you're wanting to build some kind of B2C venture with which relies heavy on marketing activities. So now, while building your financial model, your task will be to actually model that marketing funnel in your financial model, in order to see how many customers you will be able to generate with a certain marketing budget on a monthly basis. Here you will be able to see how many customers you would gain if you would be able to improve, I don't know, for example, your conversion rate during the first funnel from just 1% to 2%. Just by kind of those simple, small experience, you are able to uncover the most important value levers of your business. It's also very, very important to kind of see the correlation of revenue growth and certain cost factors. Same, of course, goes for team growth, to see if your idea is actually scalable. So meaning if you're, a pre-seed to seed venture, you don't have to worry about creating some kind of accounting compliant financial model. Your financial model is not there to be a prediction of the future, not to be able to predict how much revenue you will be able to achieve in the month of March in 2026. It's all about uncovering these value levers, exploring the scalability of your business model, and actually finding out how much funding you will need to actually get that product to market.
All right, that makes sense. Very good advice as well. Okay, and this hypothetical first-time founder, he goes on Google, he Googles a template for financial modeling for my startup, and he finds several options. They're out there. What should I keep in mind that might be missing from some of these default templates?
Yeah, so like you said, there are numerous, right now, but however, very usable financial model templates out there. It's just important to keep in mind that most of these models were usually designed for one specific business model, such as a B2B SaaS, and they often do not leave a lot of room for adaptation and individualization, right? So just basically make sure that you download many templates and just basically pick and build, just pick up the structures and streams which are applicable to your idea and business model. Do not just kind of work with the first template you stumble upon, and make sure to look at multiple templates and then kind of, build your own template through all these different templates. The most important kind of outputs of such a financial model are basically your profit and loss statement, the balance sheet, and the cash flow statement. Most of the time in these templates, you will most likely only find a profit and loss statement, since it's the most intuitive to understand. However, a balance sheet and especially a cash flow statement, if you want to see how much funding you will actually need, are also outputs which are really, really relevant also for early stage investors. So just make sure to have a look at multiple templates and just pick them apart and build your own template from that.
Okay, that makes sense. So I've found the templates, I've filled them in a bit with information about my startup, and let's say I come to you at Trustventure and I say, Konstantin, I'm ready to raise some money. This is my financial model, I've got it all ready. And you look at it and say, well, investors really want to see X. Is there something that's usually missing from what founders bring to you that you guys advise to include in that financial model?
No, great question. I mean, in addition to kind of the classic KPIs like revenue growth, user growth, free cash flow and kind of liquidity development. Investors, look in particular at your ability to basically quantify your business model in a comprehensible and structured way. So, like I said, a financial model, if you're an early stage startup, serves as a kind of virtual recreation of the business, and thus, showcases the founder's assessment of the business cases, primary relationships, and dynamics. Being just prepared to discuss and defend these dynamics modeled into such a plan is often a determining factor for closing the deal. Investors will have a very, very close look at the key assumptions of your model and how you came to those exact assumptions. Since this is often the basis of your financial model due to just missing historic data to rely on. One example, one of your key assumptions is that you will be able to price corporates at, I don't know, $50 MRR, while having a conversion rate of roughly, let's say, 2% throughout your sales funnel. What an investor will then do is, okay, what happens if that price of $50 drops down to 45? And what if that conversion rate, does not evolve how we expected, but lands somewhere at the 1 to 1.5%? Will the business still be able to grow and become profitable? So just really making sure that while you're building a financial model, you're also building that financial model for a third person, for an outsider. And so just make sure that, you can basically send that financial model to your grandmother and she will be able to kind of, get grasp of it. And that you can also, showcase where all of your assumptions come from, and that they're not just, typed in your financial model and nobody knows, what kind of your thought process there were. So, that's the main thing that we see when we talk to, first-time founders, pre-seed founders. It's just, keep in mind that you're building the financial model for investors in the first place, and that, you are always sitting there thinking, okay, if I just send this email out without any comments, will they be able to kind of, get into my head and, see what my thoughts were with my key assumptions.
Awesome. Thank you. And go ahead, Konstantin.
Yeah, and I bet, John, while you are building your first startup, you might probably need to cover a lot of things by yourself, like marketing, sales, I don't know, building support team and all this stuff. And keeping this in mind, no wonder anyone can make mistakes on this way, especially when it comes to finance. This mistake will cost you quite a lot in the future. So my question would be, can you advise and maybe comment on the most common pitfalls anyone experience on this way?
Of course. I mean, the main and again the biggest pitfall that we see is the points I talked about with the assumptions and just making it understandable for a third party, and also making it thus understandable for yourself. Because once you're kind of building that financial model, you might be working on it for a couple of months, and then you maybe want to look at it a couple months down the road, and then even yourself, you can't really get to the ground of it, what you were thinking when you typed in this assumption, that assumption. And so again, that's a point I really want to stress, is to just make sure that it's really understandable for an outsider to understand. Another common pitfall is not showing and calculating all relevant outputs that I've talked about earlier, being the profit and loss statement, the balance sheet, and the cash flow statement. Like I said, founders focus most of the time only on the profit and loss statement, since it's the most kind of intuitive thing to calculate. However, a balance sheet, especially if you're an asset-heavy venture, is just as equally important. And the cash flow statement then is really, really relevant, because the operative cash flow is one of the most important KPIs that investors are wanting to look at, because that showcases, okay, how much cash flow will you be able to provide or produce on a monthly basis without any external effects, and that together, of course, then with the cash balance development, meaning how much funding are you going to need, in the next couple months, are really the most important outputs. So again, the kind of assumptions, making them understandable for a third party, and just calculating all the relevant outputs, being profit and loss statement, balance sheet, and cash flow statement.
John, did you make notes for yourself?
Yeah. Well, I'm recording this, so I'm going to have everything to look through later when I launch my big dream startup. All right. Let's get into. I guess we talked a little bit about this before, but do you think this venture winter, this slight downturn, depending on how you look at it, will change anything about financial marketing? You know, the big headline stories seem to be about late stage companies. I know in the US and in Europe, there were some really highly valued like food delivery companies that were basically just burning a ton of money to gain market share. Is that going to extend across other industries? What do you think?
I mean, that goes back to kind of the mantra I just mentioned before, this kind of growth at all costs mantra, right? Which we've seen, you know, with all the quick commerce companies emerging, and you know that's something that will definitely slow down in the next couple of months. You know, like I said, we see a lot of VCs, you know, asking for meetings with the portfolio companies about adjusting the business plan a little bit, you know, taking in maybe a little bit of slower revenue growth, however, through that maximizing your runway. So, you know, that's definitely a trend which we will see, you know, not only months, but also maybe a couple of years down the road. And, you know, regarding valuations, which have just been going crazy the last couple of months and years, you know, that's something that will also change. You know, in the VC market, valuations, especially if you're kind of early, you know, maybe until Series A, is not something which is calculated throughout the financial model, but more so of a kind of momentum thing. You know, if you're the hottest startup out and you have basically all these VCs who are just waiting to invest into you, you know, you can just play with your valuation as you like. You know, they will not, you know, discuss it or won't raise any eyebrows. You know, so the multiples, revenue multiples will definitely go down. And yeah.
All right, let's pivot a little bit away from the money side. And when you advise early stage startups who are talking with their first investors, what do you advise them to look for outside of just the amount of money that they're investing? Are there other factors to consider when partnering with these? They could be angel investors or early stage VCs or accelerators.
I mean, you know, since these investors will probably be the first bigger investors that you will get into your cap table, there are, you know, numerous factors to account for. I think the first one and most important one is just the kind of personal chemistry and fit that you have with the investor. You know, you are engaging in a very, very long-term commitment by bringing these investors on board, and you will spend a lot of time with them throughout your journey. So just, you know, make sure that you also connect on a personal level. Another factor is, of course, you know, the investors' investment focus and thus their expertise, which they bring to the table. You know, you can ask yourself if they solely invest into your industry and business model, or do they, you know, and thus have a strong expertise there, and also a strong network there, which you will then be able to attain, or, you know, are they very opportunistic investors, you know, very holistic investors, and are you just one of the few investments in that sector, thus, you know, bringing not such a big network with them. And I think the third and last criteria is, of course, their fund size. You know, will they be able to do multiple follow-up investments? Do they have some kind of, you know, time pressure regarding their exits? You know, is their fund size almost over? And, you know, once they invest into you, will they try to push you towards the exit route in the next couple of years? So these are the three factors which we always look for in investors, and when we are almost down to signing a term sheet.
Do you know any kind of maybe red flags that any founder should keep in mind, like searching for investors? I mean, like what should stop them even thinking about working with some specific investor?
I mean, one thing that we also always do is just ask for reference calls, right? You know, you can look at these portfolio companies of all the major VC funds, and what we do is we look for ventures who are in a kind of the same industry, kind of have the same business model, or kind of, you know, the same size as you, and have been invested into at the same stage that you're in. And then, you know, just shoot them a message, ask for a quick reference call, and talk to them. How have their experience been? Have they been helpful at all? Did they just invest the money and then went on vacation for multiple years and you didn't even heard of them anymore? These are kind of all factors that you can definitely do, and we also suggest to actually invest some time into actually researching your investor.
When you raised already VC funds, for example, right? I bet that there should be some kind of strategy of after investments, like things you have to keep in mind, what you need to do. And as far as I know, there is such a strategy, after investment strategy. Maybe you can elaborate a little bit about this as well.
No, of course. I mean, there are basically two main aspects which become relevant when you've just raised your first VC money. The first one is the implementation of some kind of controlling measures. And the second one, probably the most important one, is the implementation of investor relationship management. Talking about the kind of first one, the controlling measures. Controlling is a key measure in order to actually track your company's month to month development and see where there are kind of deviations to the plan which you've originally created, in order to then implement measures to go against it. The second one, and like I said, definitely most important one, is the implementation of an investor relationship management. A lot of success in entrepreneurship is kind of knowing how to help your investors help you. The founder, the CEO needs to give their investors the right information at the right time to just allow them to contribute effectively. This happens most clearly through investor updates and board meetings. Here the key is to create some kind of consistent, readable, and scalable communication with stakeholders, meaning a consistent communication form, rather than being some kind of annual management letters, quarterly board meetings, monthly investor updates through emails, etc. Readable in form of the creation of some kind of template, and your communication always following the same structure, so that the investor, knows where he or she can find the respective information which is relevant for them. And of course, scalable, meaning that 90+% of your communication and interaction with stakeholders should be in some type of scalable form, such as emails, group meetings, so that you don't have to talk to every single investor one-on-one, but rather, aggregating all the investors, bringing all their knowledge, expertise, network together in one room, and then just, really, really transparently and honest and trust-based, communicate the good developments, but most importantly also the bad developments, so that they are actually able to help you, because these are, one of the most experienced guys in venture capital in the startup scene. These guys have looked at, hundreds of portfolio companies. So the chance is pretty high that they've encountered the problem that you're facing right now once before. So it's just all about having a very trust-based, very honest, very transparent relationship with their investors, so that they are able to help you in their most effective way.
There's quite a lot of things founder has to keep in mind, like while working on this investment part. And do you think it makes sense maybe to hire some co-founder who can cover all this while you're like working on the product development, for example?
Mm-hmm.
Or maybe like approaching some companies like Trustventure also could be an option, or maybe approaching this type of companies could be a better option on a later stage. What would you like suggest?
I mean, this differs again from stage to stage. I think fundraising, investor relationship management will always be some kind of C-level founding team job, no question about it. Because when you're pre-seed seed, the investors invest into your company. They invest into you most importantly. And so also when we advise ventures on fundraising rounds, it's not us communicating with the investors, it's not us pitching their company to investors, but that's just a founding team, a CEO's job. However, the kind of back office part of it, meaning creation of financial models, pitch decks, research of suitable investors, due diligence management, and all that good stuff, kind of the back office work, that can be delegated, quite nicely and quite easily, because fundraising will be a full-time commitment for any founder for, maybe 6 to 8 months. And not a lot of founders, especially in the early days, when they're really, really kind of product heavy, loving the product, loving the vision, they don't want to talk to investors. They don't want to do fundraising for 6 to 8 months on a full-time basis. However, when you also look down the road, into the kind of development of a CEO role, once you're kind of a late stage, meaning Series B, CD startup, the main role of a CEO will be to do fundraising and do investor relationship management. That's all you will do. That's all that you're here for, and the rest will then kind of take care of itself. However, like I said, kind of the front runner in those topics will always be the founding team. The back office work can then be delegated quite nicely. Just like at the after investment or the investor relationship management. Sorry, all the documentation behind that, all the emails, all the monthly reporting documents showcasing your financial growth and all that good stuff. That's stuff that can be done, by us, by Trustventure. However, the communication and the relationship building, that's something that cannot be outsourced. No way.
Yeah, that's a very comprehensive look at investor relationships. I had a question around that. Since you're part of the EU ecosystem of startups, are there sort of cultural differences that come up? Just for example, if there's a founder from the UK, a London-based startup that comes to you and says, I want to expand into the German market because I think it's promising for my product, I think it would help us grow. Are there any sort of cultural differences they should be aware of in terms of how an investor in Germany would want to be treated, want to have that relationship maintained positively?
No, great question. But I don't think that there are. Just due to the fact that investors nowadays are just so international, and at a German VC, the majority of people there are actually German. They're people from the US, from the UK, just from everywhere, because these investors also invest into these kind of markets and do not only invest into the German market. So I wouldn't say that there are some kind of cultural clashes when you talk about investor relationship strategy, especially not in Europe or the US. Maybe if you look at kind of the Asian Pacific market, of course, there just be some cultural differences that you will account for. However, if you're a startup founder and you have some investors from the US, you have some investors from London, from Berlin, there won't be a need to, create different emails for, all these kind of investors, create different documents. That won't be the case, no.
All right, good to know. Let's see, a while ago on Twitter, I saw this line: what got you $1 million in VC funding won't get you $10 million. Founders need to be ready to evolve. I assume that you've worked with some founders that have gone through this evolution. What does it look like in practical terms, and how does it affect sort of operations and fundraising at a startup?
The kind of this goes back to the different kind of metrics that investors look for while evaluating a pre-seed deal or a Series A deal. When you raise about 1 million from your first VC round, investors they only look at market, founding team, business model, and all these kind of qualitative factors. However, all of these investors know that maybe the more detailed aspects, such as kind of your UX or just your overall product, these will definitely change throughout your journey. There's a saying that goes, a good team will never create a bad product. So, they mostly look at these very qualitative factors, and especially, the founding team being definitely the most important one. Looking at raising 10 million plus in your Series A or B, investors will look at these more quantitative metrics that I've talked about before, such as traction, month-to-month growth, revenue growth, and also the, kind of team, your management and executive team, not just the founders, your cap table, your go-to-market strategy, your ability to kind of attract and maintain talent. Do you already have some kind of ESOP set up in your capture, and just these very kind of detailed factors which will make a huge difference down the road. Founders should definitely know that before looking to raise 10 million plus, because they will also need to collect the data over the years. Once you've collected your 1 million, you will already need to know or keep in your mind what kind of data the investors are wanting to see once you get to the series A, B level and you want to raise 10 million plus. So just kind of know what kind of data you need to collect over the years in order to give the investors that information that they need and look for, just so that you don't have to do all this work kind of backwards. And also, the investors chains, VCs that will invest into your 1 million round, probably won't go into your 10 million round, but there will then, be some later stage VCs in that. You have a lot of VCs investing only in pre-seed and seed rounds, but you also have investors which are only investing into series A and B rounds. However, the kind of duration of that fundraising process doesn't really change. The only kind of step which will take a little bit longer time is the due diligence, of course, because there's just a lot more data to actually look on for investors. If you're raising your first round, you don't have a lot of historic financial data or legal documents or whatever that investors, will have to scan and look through. That changes once you're at a series A round. However, the kind of process, as in the kind of different steps that you take once you're in the fundraising round, they don't change. It's just the data and the kind of key metrics that investors look for.
All right. Thank you for those details. And if anybody who's watching wants a really good overview of Konstantin's thoughts on the financial aspects of their startup, he has a great Medium article. We'll put in a link in the show notes about how to set up the financial department of your venture, as you said. All right, guys, I wanted to give you a chance at the end, since you did meet at a conference in person at Hub Berlin earlier this year. Do you have any upcoming events that you're going to be at that you would like to tell the audience about now? Maybe they would love to meet you in person as well.
Yeah, I'm planning to be at the conference here in Lisbon. It's a web summit. It's an annual conference. It's going to happen here in the beginning of November, and I'll be happy to meet anyone who is open.
Yeah, I will also be in Lisbon at the Web Summit in November, and
Nice.
I will also be in Munich at the Bits and Pretzels event, which is kind of one of the biggest startup events here in Germany. In I think about a month. I think it's right before the Web Summit in Lisbon. So I will definitely be there as well.
Awesome. Well, thank you guys so much for your time. Konstantin, did you have any other questions to add before we wrap up?
No, right now. I mean, just thank you guys for the great talk. I'm really happy to get to exchange some ideas and thoughts with you guys.
No more questions from me as well. Just huge thanks for being with us, sharing all these details, and I hope that we're gonna build a lot of more and more meaningful things together, like we already started doing.
For sure, yeah. And I look forward to hopefully sharing some of the work that you do with our accelerator startups. Maybe we can pull out some examples of great early stage financial modeling for other founders to learn from in the future. So thank you so much, guys. Have a lovely week and enjoy your time in Lisbon at Web Summit.
Thank you, John.
Thank you,
Konstantin.
John.